You have funds like ETFs, for example, VTI, SPY, and VOO. By the way, personally, I'm invested in VOO. These are funds that give you exposure to pieces of the American economy. VTI, if you buy one share of this fund on any brokerage, and pretty much every stock brokerage will allow you to invest in VTI, you will own a piece of the total stock market. So this gives you exposure to the 2,000 some stocks in the United States stock market. You don't have to go out and invest in all 2,000 of those companies. If you buy one share of this fund, you will own those 2,000 some stocks, and you don't have to do anything except buying one share of that fund, or as many shares as you want. But if you want to get a little bit more niche, you can also invest in the S&P 500. That's the group of the 500 largest companies in the stock market. So now we're not looking at all the thousands of companies, we're just looking at the 500 largest companies in the stock market, and you can invest in those 500 largest companies by investing in a fund like SPY or VOO. These are two different funds that give you exposure to those same 500 companies. And now as soon as you invest in one of these companies, well, you own those 500 stocks. And the nice thing about this is if one of those largest 500 companies starts to struggle, they will get kicked out of that fund and replaced by another stock, and you don't have to do anything. So hypothetically, McDonald's is a part of the S&P 500. If they start serving bad hamburgers and they start to struggle in the real estate business and they're on the verge of bankruptcy, well, McDonald's would be kicked out of the S&P 500 and replaced by another stock, and you don't have to do anything. That's the advantage of investing your money into these types of funds because, well, it's less work on your side. And the way that you win as a passive investor here is by following a strategy I call ABB. Always be buying. What that means is you need to create a system where every week, every 2 weeks, or every month, money is pulled out of your checking account and is automatically invested into your portfolio of funds. So if you were going to invest in the S&P 500, and let's just say that's the only thing that you do. The S&P 500 has averaged a little over 10% over the last 50 years and over the last 100 years. And so the way that you could do it is you just pick an S&P 500 fund. Again, I can't tell you what to invest in, but if you do that, now you set up a system where every week, every 2 weeks, every month, money is pulled out of your checking account and is automatically invested in your fund. And then you forget the password. You don't touch it. That's why I call it always be buying. That's the way that you win. So now when markets crash, you keep buying. Markets are booming, you keep buying. Markets are sideways, you keep buying. You have a Republican in the White House, you keep buying. You have a Democrat in the White House, you keep buying. It's raining, you buy. It's sunny, you buy. You get the idea. The mistake and the reason why so many people lose is because they forget this A. Always. They come up with whatever excuse that the economy is going to crash, that the dollar is going to collapse, that all these crazy things are going to happen, and so I'm going to stop buying. But if you stick with it, and you don't sell, and you hold on to it, it has been proven for decades to win. So if you want to get the market returns, the way that you do that is to always be buying and own some funds that give you broad exposure to the American economy. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.